With the debt cycle debacle presumably behind us, hopefully, we can now turn our attention back to the economy and obsessing over the Federal Reserve. Economic data remains lackluster and economists are split on whether the Federal Reserve will hike again during their June meeting or whether a pause is in order. Regardless, it is evident that we are nearing the end of this rate hike cycle. However, is a recession imminent? Not necessarily. The labor force remains stable, although consumers are beginning to weaken based on record US credit card debt levels and low savings rate that also show the average American savings that have been largely wiped away since the pandemic. So with all that being said, it's 50-50 on whether we fall into a recession. The market's favorite recession indicator happens to be the inversion of the yield curve, meaning the 2-year Treasury bond is higher than the 10-year Treasury bond, which has now been the case for over 220 consecutive days. With all that being said, if you don't know by now, what we do on this channel is consistently scan stocks for great long-term entry points. We're not buying for a 5% pop tomorrow, although that would be nice. We are looking for high-quality stocks at great valuations. As such, in today's video, we are going to take a look at 5 of the best dividend stocks to buy in the month of June. But before we begin, if you could do me a huge favor and click that like button down below, subscribe to the channel, it would be greatly appreciated. Go ahead, I'll wait for you. All right, thank you. Let's get started. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your own due diligence and do not take this as financial advice. And before we begin, let me take a quick moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources, tools, and products for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now, completely free. All right, let's take a look at our 5 best dividend stocks to buy in the month of June. Beginning with dividend stock number 1, which is Qualcomm, stock ticker QCOM. Qualcomm is a carryover from last month's top picks, and although they struggled after reporting their quarterly earnings, they have gained back much of that in the last few days. Qualcomm has a market cap of $129 billion. Over the past 12 months, the stock is down 19%, but year to date, it is up 8%. If you keep up with the market in any capacity, then you're probably well aware of the AI craze that has taken over in 2023. Look at stocks like Nvidia and Meta Platforms, which have doubled here just in the year 2023. We're talking about we're only 5 months in. And then a competitor of Qualcomm, which is Broadcom, stock ticker AVGO, a stock that I hold within my dividend portfolio, is up 45% year to date. But Qualcomm has been left behind. Why is that? Number 1, the recovery in China has been a lot slower than many had expected. At the end of last year, China reopened completely, taking away their COVID-0 restrictions. But many companies baked in a lot of growth expectations with the reopening of China that just hasn't come to fruition yet. Secondly, handset sales are down across the globe, down 17% for Qualcomm alone. When the company reported their Q2 earnings, they were actually in line from an EPS standpoint, and they beat on sales. But the company also gave pretty light guidance. EPS came in at $2.15, which I mentioned was in line. Revenues for the quarter came in at $9.28 billion, and analysts were expecting $9.1 billion. There's the beat on revenues. But in terms of guidance, Q3 sales are expected to come in at 8.5, but the street was looking for 9.14 billion. And EPS guidance also came in light at $1.80 when analysts were looking for $2.16 per share. Definitely some huge gaps there between analysts and management. Qualcomm also had negative cash flow during the quarter, as their cash position decreased by $1.3 billion. However, they remain cash flow positive on the year thus far. In terms of free cash flow, Qualcomm generated $3.7 billion in free cash flow through the first half of the year, compared to paying out dividends of $1.7 billion, which equates to a free cash flow yield of 46%, which tells me the dividend is plenty safe at the moment. Speaking of the dividend, Qualcomm pays an annual dividend that yields 2.9%, and over the past 5 years, investors have seen the company increase their dividend at an average of 5.2% per year. So not a ton in terms of dividend growth, although the last 2 hikes have been above the average rate, which is positive. Now for valuation. Analysts are looking for FY 2024 adjusted EPS of $9.57 per share, which equates to an earnings multiple of 12.1 times. For comparative purposes, over the past 5 years, shares of Qualcomm have traded at an average earnings multiple of 17.1 times, and over the past decade, closer to 15.7 times. The second dividend stock on our list today is Johnson & Johnson, stock ticker J&J. Now, many of you are already well aware of the company Johnson & Johnson, but there has been some changes within the company over the past few months. The company rolled off its consumer health segment into a completely new and separate public company called Kenvue, which trades under the stock ticker KVUE. So the new Johnson & Johnson still has the pharmaceutical segment as well as the medtech segment moving forward. To give you an idea on how big each of these segments are, here's a look at the company's recent quarterly results, which shows consumer health accounted for 15% of company revenues, the medtech segment coming in at 30% of company revenues, and the pharmaceutical segment, by far the largest of the company, comes in at 55% of company revenues. Johnson & Johnson has long been a major player within the pharmaceutical industry, and they have a ton of great products that are already out to market, but they also have a very strong pipeline coming down the line. The medical device segment, also known as medtech, is also expected to return to growth after taking a breather during those pandemic years. Johnson & Johnson currently has a market cap of $401 billion. Over the past 12 months, the stock is down 14%, and year to date, it is down 13%. In fact, shares are trading very close to their 52-week low, giving investors a great opportunity to add to this healthcare conglomerate. We are talking about a company that has a safer credit rating than the US government, if that's saying anything. In terms of the dividend, Johnson & Johnson has paid a growing dividend for more than 60 consecutive years. The company currently yields a dividend of 3.1%, and they have a 5-year dividend growth rate of 5.7%. With the stock trading near the 52-week low, let's take a look at where that puts the company's valuation. Analysts are looking for 2023 EPS of $10.65 per share, which equates to a 2023 earnings multiple of 14.5 times. For comparative purposes, Johnson & Johnson has traded at an average multiple of 17.7 times over the past 5 years and 17.2 times over the past decade, making now an opportune time to add to J&J. The third dividend stock on our list today is United Healthcare Group, stock ticker UNH. United Healthcare is another carryover from our May picks, as the stock really didn't move all that much in the last month, which is giving us another opportunity to dip our toes into this great stock. For those of you that are unaware, the Dow Jones Industrial Average is actually a price-weighted index. Unlike the S&P 500, which is weighted based on market caps, the Dow Jones Industrial is price-weighted, meaning per share price actually matters. And the company with the largest weighting, meaning the highest stock price per share, is United Health Group. It currently has a market cap of $447 billion, and over the past 12 months, the stock is down 3.5%, and year to date, they are down 7.5%. So really just stuck in idle of late. United Healthcare is a behemoth in the healthcare sector, contributing 7.7% of US healthcare spending today from their United Healthcare and Optum segments. Piper Sandler recently initiated coverage on the stock, giving it an overweight rating, which is a fancy way of calling it a buy. They gave the stock a 12-month price target of $580, which implies 21% upside from current levels. The average price target on the street is $595 per share, actually higher, which implies 24% upside from current levels. UNH currently yields a dividend of 1.4%, which is not all that much, but the intriguing part from a dividend standpoint is the 17% 5-year dividend growth rate the company has. UNH has increased their dividend for 13 consecutive years. In terms of valuation, analysts are looking for 2023 EPS of $24.95 per share, which equates to a 2023 earnings multiple of 19.2 times. For comparative purposes, UNH shares have traded at an average multiple of 21.5 times over the past 5 years and 19.4 times over the past decade. Dividend stock number 4 is AT&T, stock ticker T. I know, this one could be a little controversial, and I have owned AT&T in the past, but luckily I got out of it prior to the pandemic plunge. I got out around the low $30 limit. But I had my reasons for selling, and I'm not someone that sells stocks all that often. But if something changes fundamentally within the business, then I will look at selling it. And that's exactly what happened with AT&T. They went from this telecom giant and they wanted to get more involved with DirecTV, overpaying for DirecTV, and then wanted getting more into media, overpaying for Warner Media. But under the new leadership of CEO John Stankey, he has gotten rid of those acquisitions and returned to the roots of what made AT&T the telecom giant that it once was. 5G continues its rollout, and there's a huge role for all of the telecom giants to play and to take part in. So know this going in, there's still a lot of risks with the company. There could still be volatility. They still have a huge mountain of debt to work out, and they still have fierce competition with the likes of Verizon and T-Mobile. AT&T currently has a market cap of $112 billion. Over the past 12 months, the stock is down 26%, and year to date, they are down 16%. In recent weeks, when the 13F filings came out, which shows what stocks hedge funds are buying and selling in the last quarter, there was a lot of names on the list that showed positions being initiated or added to for AT&T. One of those was billionaire owner of the New York Mets, Stephen Cohen of Point72 Asset Management, who added over 9 million shares of AT&T, a completely new position. Ken Griffin of Citadel Advisors added 27 million shares in the last quarter alone. AT&T has long been known for their high-yield dividend, but last year the company decided to slash the dividend by nearly 50%, deciding to take that cash to reinvest back into the business and also pay down debt. However, the dividend yield is still high at 7.2%, and because of the dividend cut, there is no dividend growth at the moment. Now for valuation, analysts are looking for adjusted EPS of $2.41 in 2023, which equates to a 2023 earnings multiple of 6.5 times. That is incredibly low. For comparable purposes, over the past 5 years, shares have traded at an average multiple of nearly 12 times and 15.1 times over the past decade, if you can believe that, making AT&T a low floor play at these levels. The fifth and final stock on our list today is Tyson Foods, stock ticker TSN. Tyson Foods is a major food player here in the US that has come under intense pressure over the past year and especially lately after a poor earnings result. The company has a market cap of $18 billion, and over the past 12 months, the stock is down over 40%. Year to date, Tyson Foods shares are down 18%. That is a nasty chart to look at, to say the least. Concerns around the company have been due to rising costs, which have eaten into profit margins, no pun intended, but the inflationary environment that we're in is definitely taking a toll on Tyson Foods. Part of the reason for the decline is due in part to the last 2 years being some of the best years for the company. Looking at this chart, you can see the company's share price rise from the summer of 2020 to new highs in the winter and spring of 2022. But since then, it has been falling and falling fast, with the latest quarter being the final straw for investors as the stock fell more than 15% after earnings. The Tyson Food Management Company completely understands this, and they're trying to get their costs under control. At the same time, they've been investing in becoming more efficient, both through digital as well as automation, which should definitely start showing through the results in the years to come. Knowing this, as well as seeing the full-fledged sell-off that we saw in the shares in recent weeks, is another example of a company that has a lower floor. There's been a flush out that we've seen in recent weeks, which gives me an idea. Knowing that there's cost cut measures coming and this company can definitely turn things around tells me this is a low floor play for Tyson Foods. TSN shares currently yield a dividend of 3.7% with a 5-year dividend growth rate of roughly 10%. Management has also increased the dividend for 11 consecutive years and counting. In terms of valuation, with the stock selling off hard recently, shares of TSN now trade at an FY 2024 earnings multiple of 14.9 times, which is not all that great considering their 5 and 10-year averages are 11 and 12 times respectively. However, we know the cost-cutting measures are underway and there's profit challenges in the near term. But assuming the company can get back to pre-pandemic EPS levels, which is not all that crazy if you ask me, then we are talking about a stock trading in the single digits. TSN is definitely a name that you want to add to your watch list. So there we have it, folks. 5 stocks to consider for your portfolio, your dividend portfolio in the month of June. It's an array of all different types of stocks. You have Qualcomm, who hasn't really partook in the AI craze yet. You also have Tyson Foods and AT&T that look like low floor plays. They still have some headwinds and they may have a little bit of volatility, but the entry points right here look very intriguing. And then you have two conglomerates. You have United Health Group and Johnson & Johnson, which are leaders in their respective industries. In the comments section down below, let me know which of these 5 stock picks you like best. And if you haven't done so yet, please make sure you subscribe to the channel, hit that like button down below, and we'll see you in the next video. Take care.